Good morning, everybody, and welcome to the second of our six episode series on property investment. And thanks for joining us again on this Wednesday morning. Looking forward to sort of having a conversation with you guys about finance and structure, investment structures, and I've invited Uber, one of our business partners, Uber, along to have a conversation, and Justin Easthorpe from Uber will be having a chat to you guys just about traditional finance and bank finance and where things stand at the moment, considering the environment we're sitting in. So just going to get straight into it and go from there. So I'm just going to share my screen and we'll start just on the presentation and what we're going to be dealing with today. So, okay, yeah, cool. So, sorry. So just quickly, I don't know if there's a couple of you guys that have joined us or didn't join us last week, but the schedule really is last week we dealt with strategies, goals, and our expert team. So just discussed a few things around that. I'll do a revision now on that. Today we're going to talk about asset protection structures and finance. So just how do we finance our property investment deals and what sort of structures do we invest through and what's the ideal structure at least. Next week, day 3, we're going to talk about the offer to purchase and conveyancing, and we'll have one of our conveyancers, expert conveyancers with us, talking about the conveyancing process and the offer to purchase itself, so what you need to understand in terms of that agreement to buy property. We're going to talk about tools and research, which is how do you investigate a property. Yes, you've got estate agents that you work with. Yes, you've got your accountant, but what are the tools that you can use to determine whether or not that investment is really going to be a good deal for you, without relying on somebody else that might not have a vested interest from you. Day 5 is going to be on running the numbers. So I'm going to talk about return on investment. My background is in accounting, so it is really my favorite part about property investments is just running the numbers and digging into the Excel spreadsheet to make a decision on that investment. And the thing to remember about running the numbers is that Excel spreadsheets are unemotional. You get emotional about property, you feel really good, it feels nice, it looks nice, you know, you fall in love with the kitchen or something with the property, where the pool is, the location, the views, but ultimately the Excel spreadsheet says to you yes or no, should you or should you not invest in that property. And the last one we're going to deal with is property management and Rental Housing Act and evictions. So really saying, well, once you've got this asset that you're holding on to and you're trying to achieve an annuity income, how do you protect yourself? How do you de-risk yourself? And what are the things you need to put in place to make sure that you manage these properties correctly and efficiently to maximize your income? So it's really important. And there's a big difference between property management and asset management, and I'll discuss that a little bit during the course of the series. So Donovan has just asked if you can get details of the recordings of the sessions. Absolutely. The franchise that you've come through, so the Unrealty franchise you've come through, we'll be able to give you a YouTube link to all the recordings. We've already put the first session onto our YouTube, the Unrealty YouTube channel, so you can just access that there. And what I'll do is just see if one of the team can send it to me via WhatsApp, and I'll post it into the comments box or the chat box for you guys. Cool. So next one is I just want to get then into sort of the details. If you haven't been onto a Zoom webinar before, there is a chat box. The chat box is just where you're going to have a chat. Just say hi to everybody or a little bit of sorry, a Q&A box where if you want to ask any questions, you put the questions in there, then I can see those. And also, obviously, once we provide the recorded live Zoom recordings, those chat boxes are then kept, and all the questions are actually put into the webinar, so people can see what the questions that were asked and being answered. So we'll just do that. So it's a pleasure, Donovan. Megan from our head office has put up the YouTube link in the chat box for you. So next one is, this is an interactive session, so please don't let me just talk at you. It can be quite a long session, an hour and 15, hour and a half of me just talking at you. Could be quite a long period of time. So ask the questions if you need me to sort of clarify anything I'm talking about, dig deeper into it. You know, we do this day in and day out, so I might use phrases that you might not understand, and any question helps because anybody else might be thinking the same thing. So please ask as many questions as possible. And that's really my last point is, sorry, my second last point is, if you do ask a question that I'm going to deal with later in the series, for example, you ask me something about evictions today, I am going to point you towards episode 6 and just say, you know, hang on for episode 6, we will deal with evictions. I just want to make sure we're dealing with the subject at hand today, which is finance and structures, as in-depth as possible, and then go from there. And again, the last point here is please ask questions. It helps sort of drive the conversation towards what you need and want out of the sessions. Next one is just a quick introduction again. Sorry for those of you who had it last week, but my name is Grant Smee. I'm the Managing Director of Realty, have been for the past 9 years. I'm also the founder of Epic South Africa, which is a property investor and entrepreneur community, support community for training and education. And lastly, I'm a property investor. So that's the core of where I've come from. Started investing in the UK almost 15, 16 years ago, and have continued investing in property. And that's really sort of what has driven everything to have an entirely property focus in the services space, being only Realty and Epic. Cool. So today we're going to talk about asset structure and financing, but I just want to sort of go back and talk about last week quickly, and just a quick revision of what we spoke about last week. So for those of you who missed last week, can then maybe go on to the YouTube channel, just check out the link for last week. So we spoke briefly last week just about strategies and goals, and really first thing is to sort of decide what is your goal, and then therefore what is the strategy you're going to be achieving. So if you need to have a lump sum of money at the end of the next year, or you want to create a annuity income, or you want to retire, you want to leave your job, you want to buy a nice car, you want to go on a holiday, what is the ultimate goal behind your investment strategy? I think too often people get into a space where they just buy property for the sake of owning property because it's the buzzword. They read Rich Dad Poor Dad, and they're like, I've got to buy property, versus actually understanding what are they going to get out of that property and how does it align with the goal they're trying to achieve. So it's important that if you are getting into a space where you're going to start investing, you either sit down and you write down the goals you're trying to achieve, and therefore identify the strategy you need to follow to achieve that goal, or you need to sit down with somebody who understands strategies and goal setting in the property investment space and really works with you through that. And a really good example, I'm using here a ski example, skiing from the top of the slope to the bottom of the slope, but a better example is the Comrades Marathon. Everybody stands at the starting line, and they haven't bought a property, they're looking what they want to do, they don't know what's to come. And if they don't know that the goal is to run from Pietermaritzburg to Durban, they could be standing at the starting line of Pietermaritzburg and run 89.9 kilometers in any direction, and we see who wins. And there's no way we're going to know who wins because nobody's actually identified the goal of getting down to Durban. So you're standing at the starting line now, you need to identify a goal and what's the route you're going to follow to get there and achieve the goals. What are the breaks you're going to take? What are the what resources do you need on that journey to get to the end goal? So that's ultimately what strategy and goals really relates to. So we spoke about raising capital, so getting capital to buy your portfolio, or also following a capital strategy. We might do developments or flips, or just raise some money to get into property. And remembering property investment is quite capital intensive, although I will talk about some opportunities or ways you can get into property today through alternative financing methods that you can get into property with less capital, or less of your own capital at least. And then really I sort of dug into cash flow last week because, ultimately I sort of differentiated between a capital strategy being a little bit speculative and then getting into the space where cash flow is really what you're trying to achieve on an annuity basis. We're trying to create that annuity, or that continuous income, which really drives your sort of future investment strategy. And that's the thing that changes your lifestyle. And again, last week I referred to the fact that, capital strategy or capital appreciation, whereas if you've got a cash flow strategy generating monthly cash flow from your properties, you could use that money to buy a trip overseas, as an example, if that's one of your goals. And the last part of last week was just talking about your experts and their roles and their professional team. We spoke about geographic and non-geographic guys. So guys that are non-geographic, or guys that don't need to be anywhere near the property but still offer their services, your accountant, your tax advisor, your conveyancing attorney, your lawyer, and then the guys who are geographically located, or your builder, your project manager, your engineers, potentially your architect, your town planner, those guys. So we sort of delved into that last week a little bit. So that was sort of a revision of last week. So to get started now today into asset protection and finance, I just want to, there we go. Okay. So the thing to remember that asset protection is not only, it's not just asset protection and asset protection structures, but it's actually your investment structure. So how do you get into this, and what are you doing? So that we're talking about your investment structure and your finance, and I put them together because they truly are interdependent. There's an interdependent relationship between the finance you're going to obtain and the structure you're going to use. The banks look at things differently if you use different structures. The National Credit Regulator regulates lending to consumers whereas there's a different look at you if you're investing through a company. So there are things that you need to consider. You're building a business if you're investing through a company. You're building a personal investment or personal wealth if you're building your own name. There's different tax implications for doing certain things, and I'll speak about those a bit later. But just remember, there is a real relationship, an interdependent relation between the finance you're going to achieve and the structure you're looking to get. And this is the real advantage of property, and why property is such a great asset class. If you go and buy shares, and you go and buy shares right now, and you go and buy shares, let's say if you really wanted to in Sasol or anyone, to be honest, or even indices, if you want to go and buy shares directly into some of the like I say, in some of the indices, you're going to invest 100 Rand, and you're going to have 100 Rand worth of shares. But interestingly about property, where the leverage comes in, is that you can put 100 Rand into property, but potentially get 900 Rand worth of finance. So you actually own a 1,000 Rand asset for only 100 Rand down. Now, there's obviously a cost to that finance portion, and that's what we'll talk about. But remembering that the advantage of the asset class, or the asset itself, is that as that asset grows in value, you keep 100% of the capital appreciation on that asset. You don't share a 90-10 split in that. So that's vitally important that you understand that that's where the leverage comes in, and that's the big advantage behind buying property. Now, I'm speaking to the converted because you're on this call or this webinar because you believe that property is the right investment strategy for you. I just want to add to this that I believe that we're going to a long tail of post-lockdown buyers market. So those of you that are very interested in either buying property or for first-time home, first-time investment, or expanding your portfolio, we're going to quite an exciting time from an investment point of view, because there's going to be a lot of opportunities on there. Unfortunately, those opportunities are created by financial loss, financial issues on one side, but what that does on the other side is create quite a lot of opportunity for us on our side. Okay, so to get straight into it, like I mentioned earlier, I invited Justin along to join us today, and Justin is the sales manager for Uber, and he's just going to talk to you guys briefly about he's going to talk to you briefly just about traditional finance from a banking point of view. So just quickly want to get him up and just welcome Justin to the call. Justin, you there?
Yeah, do you want my video on or off?
Yeah, on is perfect, man. Oh, yeah, welcome. Thanks for joining me today. I appreciate it. I'm sure the guys appreciate it. So yeah, so just like I said, the guys that have joined the call are all only real clients, investors, or tenants looking to buy properties, either building their portfolio or buying their first homes. So just to for you to just have a chat about what the banks are doing at the moment and how things look from a finance perspective.
Great, thank you, Grant,
Thanks.
and morning, everybody. So yes, we are going through interesting times. The banks are not as difficult or looking at their scorecards as harshly as we would have expected to for them to have done in the lockdown. Just with regards to an update on how the banks are viewing existing client bases or existing bond applications, we've only had one bank that's changed what we call the loan to value criteria. So what the loan to value criteria in essence means is depending on what sort of sector you are working in, or whether you're employed or self-employed, and what your income looks like would depend on what sort of deposit requirements that particular bank would look at. At this stage, we've only had one bank that has changed their loan to value criteria. So things are still looking very positive. And I think what's very interesting to note right now as investors or anybody purchasing property at the moment is that our interest rates are at the lowest they've been for 40 odd years. So when one wants to gear, this is a perfect opportunity because money is cheap. Money is really cheap at the moment. So it's a huge opportunity for all of you. And as Grant said as well, there is an opportunity to purchase property. On the one hand, it is a buyer's market. And unfortunately, on the other hand, there are people that are going through financial difficulties, which are going to have, who need to offload their property as well. So, you know, we're still dealing with the likes of FNB, Standard Bank, ABSA, and Nedbank, Investec as well. And there was a slight sluggish start at the beginning of the lockdown when we were doing our submissions, but they're all hands on deck now, and our applications are going through smoothly. No, as I said, no real changes to scorecard. Banks are still sticking to their old scorecard, and I'll mention the bank. It's FNB that's changed their loan to values slightly. And also something interesting that's happening in the market while being in lockdown is that we are still seeing offers being signed and people buying property, and whether that be that they had seen the property before the lockdown occurred, or that they taking virtual tours through the property, signing an offer to purchase, and just noting on the offer to purchase that they'll finalize that particular sale within a specific amount of days after the lockdown, so that one can go and view the property and are happy with the property. Something else that the banks are also allowing us to do is, if you are interested in the property and the buyer and seller agree to the purchase price, but one is not able to sign that particular offer to purchase, the banks will assess the application without a signed offer to purchase, and the offer to purchase will then be concluded at the attorneys when they sign the particular transfer of the bond documentation. So, Grant, I don't know if there's any other questions or if there's anything else you want to raise with regards to traditional finance. Do you want me just to go to traditional finance versus normal structured or versus structured lend?
Yeah, please, that'd be great. Perfect.
Okay. So I think just to clarify what we mean by we call it vanilla finance. So vanilla finance is a home loan at the commercial banks, which is, I purchase a property for R1 million. Either they give me R1 million bond, which means that you've geared yourself to 100% on that particular transaction, or they request a deposit from you depending on the loan to value criteria, or depending on your score when it goes to the scorecard. So just the process that one follows is you sign an offer to purchase, you complete a home loan application form, you provide the bank with all the relevant documentation pertaining to the affordability of that transaction, and the application is then submitted to the bank. The bank will then assess the application based on bureau score and based on affordability. If the bank is happy with bureau score and affordability, the application then moves into the valuation stage. Just to go back to score and affordability, the banks are regulated by National Credit Act that stipulates that you have to be able to prove to the bank that you are able to afford the facility at time of submission. So basically what that means is, what is your net income, less your declared expenses, household expenses, less your contractual debt, so vehicle finance, existing home loans, which will give you a net surplus income. So let's say a bond of R1 million, you need 10,000 Rand. You need to show the bank that at the end of every month, you've got 10,000 Rand to be able to afford the facility. When we're talking about scorecard is derived through bureau score and internal behavior at banks. So if a consumer has not been able to pay contractual debt, or they've had unpaids on their account, or they haven't managed their accounts correctly, the banks could say, I'm not prepared to take 100% risk on this transaction, and I would like the home buyer to put a deposit down to mitigate the bank's risk. So once we've received what we call an approval in principle, the banks will tell us we are happy with the loan amount, we are happy with the term. The term is usually on a home loan 240 months, but depending on age, it could reduce. And then they will say, I'm happy with it, and let's move to evaluation to see if we're happy with the security. Because what the bank needs to value that property to ensure that the security is in place. At the moment also, the banks have now all open to do valuations. Before, at level 5, nobody was allowed to go out and do valuations, so banks are now doing valuation. There's two ways of doing a valuation as well. Either the bank will go into a physical valuation by sending out an assessor, or they will do a desktop valuation where they will gather the selling prices and register in a particular area through Lightstone. The bank is happy with that with the value of the property, the bank will issue a final grant. Final grant means that they are happy to grant you the facility. If the home buyer is happy with that particular grant, the application or the grant or the transaction then moves to the conveyancing attorneys, and the conveyancing attorneys then take over the process to complete transfer and registration. So when we talk about a vanilla bond, there's really, is the bank giving me the loan amount I require? Is the bank giving me the term that I require? And is the bank giving it to me at the required price that I believe is reasonable? The structured lend is slightly different, and a structured lend really is where your private bankers get more involved. So from an origination point of view, that would be the likes of an Investec or an RMB or an F&B Private Wealth. And that is looking at possibly a completely different structure where they consolidate properties into one account. They take a view of risk and not necessarily only on the value of the property as a normal vanilla home loan. So structured lending is slightly different in that they look at security lending more than affordable lending as well. That's it.
Great, cool. Justin, so I've got two questions here quickly for you that have come in. And I think the second one is sort of relevant to the structured versus vanilla finance. But let's go firstly. Maybe we should have done this part first, which is what is Uber and what is the role in the business?
Okay, perfect. So Uber, OOBA, we are a mortgage originator. So our primary function is to assist the home buyer in obtaining the best possible deal from the banks. So about 20 years ago, what used to happen in real estate is that the consumer was able to go to their own bank or through a building society and go and apply for a bond. Or if the consumer wanted to, they could go to all of the banks themselves to apply for the facility. What mortgage origination allows for is for one application, one submission to up to 6 banks, and to allow each bank to compete through one application rather than a home buyer going directly to their own bank, because you don't also want to go to your own bank only because you don't know if another bank will give you a better deal. And at this time, it's prudent for you to shop that deal because the banks are so aggressive at the moment. So it's one application to up to 6 banks and allow us to negotiate on the home buyer's behalf.
So I mean, for lack of a better way to put it, it really is a price comparison space, or a rate comparison space where you guys have the expertise, and you've got some of the bank's credit people on your floor as well. Is that right?
Yes. Yes. So the structure with Uber is that we have contracts with all the major banks, which means that we have service level agreements in place, and we have access to the credit managers, the head of home loans, and head of pricing. So because we are such an integral part in the bank's home loan system, we give them in excess the origination space. In some banks, give 90% of the home loans through the mortgage originators rather than through their direct strategies. We have credit managers, yes, on our floor in Cape Town. We have an open line of communication to credit managers, to heads of home loans, and to heads of pricing. Whereas as a client that's going through their banker will not have that sort of access to those sort of people within the banks.
Awesome. And you also are very good at the sort of objection space. So you'll take a look at a case that might not have got finance and go through a nice sort of objection space as well.
Definitely. So if we don't believe in the bank's decision, we will arbitrate until can arbitrate no more. And I think what's also very interesting for everybody is that a lot of our consultants are ex-bankers. So, you know, a banker dealing with a bank is much easier because we know what a credit manager looks at and how to motivate it in the eyes of a credit manager.
Cool. And then Ipiling's asked here, who pays you and how do you earn your income? And I mean, I can just say that you charge the consumer an absolute fortune of nothing.
Yes, absolutely. So it is a free charge, home loan comparable service free of charge. The banks pay us on the registration of a bond. And I think just to clarify where that cost saving comes from in the bank's point of view is that in the past, the banks used to have consultants calling on real estate. So the banks had to pay those consultants, and they had to pay their car allowance, and they had to pay their cell phones and things like that. So the banks have now outsourced the Uber, the bank's consultants to the likes of an Uber.
Awesome. So cool. Next one is so David Roberts says, why do the banks want employment income for bonds, and do they not want to look at people with full ownership of property and renting out those properties? So let's assume that they've got a portfolio, no finance, no bonds on those properties, and they're renting it out. Will the banks look at that rental firstly? And this is also where I think there's a difference between the vanilla and the structured finance. But
absolutely. So if we look at a vanilla home loan, will the banks discount the rental entirely? Absolutely not. They will look at rental income. However, they take a lower amount on the rental income. So let's say, for instance, you're receiving 10,000 Rand in rental on a particular property. The banks are not going to take that full 10,000 Rand into account as income. The reason for that is there's a much higher risk of a tenant not paying than an employer paying. So for instance, FNB has just announced now that they will only look at 50% of rental income going forward, because they believe that perhaps some tenants are financially strained and are not able to pay their rental. So bottom line is that the banks view income from an employer or from a company as more of a stable income than that of a lease agreement.
Awesome. Cool. So, so that's all from David. And then we've got two questions here from Seth. Just quickly, so is it now here? So do Uber handle second bond application when one needs to access equity on an existing bond?
So we unfortunately only have a contract with two banks, ABSA and Standard Bank, on what we call further advances. So and we're actually currently doing a pilot now with all of our ABSA bonds, where we've registered in the last 6 years to offer the clients to release some equity in their bonds. The other banks, unfortunately, we don't have contracts with, so we have to refer them directly back to the banks. But it is a great opportunity now to also for the consumer to try and access additional cash flow through their property. So yes, we do, but we limit it to only two banks.
Awesome. And I mean, my hope is that the banks eventually will come to the party with some sort of investment financing that they have, like in the UK and the US, where it's really structured around buy-to-let as a business versus these individuals who are running buy-to-let portfolios. They've got to make a differentiation between a property landlord and a property investor, and somebody who's just doing it as a sideline private deal. Hopefully that comes. So the next question.
Well, sorry, Grant. ABSA's gone quite a far way with that. So if we look at what ABSA's doing at the moment in the buy-to-let space, is that they're taking rental income, 80% of the rental income, on the third property purchased. Yeah. So they are slowly looking at it. And I think, what we see is if one bank launches a product, it doesn't take much longer for another of the other banks to follow suit.
Yeah, hopefully they do. Awesome. And then does Uber do commercial finance at all?
We don't. We refer that to Paragon Lending.
Yeah, awesome. Okay. So, I mean, and Paragon and the guys there are awesome at that space. I mean, that's their speciality. And ex-bankers again, so from Investec. So really good guys. Awesome. So then do the other banks, the FNB are looking at 50% of rental income. You mentioned ABSA on the third bond are looking at 80% rental income. What are the other banks? Standard Bank, Nedbank, what are other banks doing?
So Standard Bank has a weird calculation. They look at the net figure of your rental. So what are you receiving as rental? What are you paying out, and what's your net of that? Nedbank looks at around 60 to 70%. ABSA, as I said, that it's usually around, besides FNB at the moment with their change, it's around 60 to 70%, depending on the bank.
So all the banks do consider some of the rental income at least.
Absolutely,
Awesome.
absolutely.
Cool.
I
And I mean,
see there's something about.
So I just want to note there that the 70%, they still take that against your living expenses. So it's not like they just take the out of a 10,000 Rand bond rental. They don't just take 7,000 Rand and add it to your income. They take that 7,000 Rand, but they also take into consideration the expenses attached to that property. So you're still going to be in a net negative position. So they are still really protecting themselves and defending their sort of or de-risking themselves.
Yeah.
Cool. Sorry. So you had a.
There's talking here about the Uber bond indicator. I don't know if we want to talk about that.
Yeah, please. I mean, Megan,
Okay.
so for those of you that might have seen, Megan from our head office has put up the Uber bond indicator link in the chat box, which you can use. And Justin, if you can just explain what that is.
Yes. So the Uber bond indicator is a digital platform for you to calculate and work out what your affordability is. So what the Uber bond indicator does is the first thing it does is it does a credit check. And the credit check also doesn't leave a footprint, so you don't have to worry about that. And then you move into an affordability calculation. There's two ways of doing the affordability calculation online on the Uber Bond Indicator app. Is either you input your information, your income and expenses, and determine a net surplus income, and the indicator will give you how much you can qualify for, or you can also upload your bank statements and the system will determine debits and credits, calculate a net surplus income, and issue you with a certificate as well on your net surplus income. We also do offer a qualified buyer certificate, which means that we will obtain all the information from you, all of your financial information, the application form, your proof of income, your bank statements, and we have a department in Cape Town that will assess your affordability and issue with a certificate based on return to income. So let's just go to return to income quickly. The banks will not allow for a home buyer. Let's go back. Return to income is your bond repayment cannot exceed more than 30% of your gross monthly income. That's the first calculation the bank will always look at. The second calculation is, do you have net surplus income enough at the end of every month to be able to afford the bond? And secondly, the associated expenses with the transaction, the property being purchased.
Yeah, awesome. Cool. So, I mean, there's no longer guesswork. You guys already put a tool in place that allows people to go online, see exactly what they can afford, even get that certificate, which puts them in a much stronger negotiation position when they're trying to negotiate for a property. So, I mean,
I think it's important. Yeah, and I think what we're going to see as well is going forward, buyers are not going to, or sorry, sellers are not going to want too many people walking through their houses. Yeah. So, you know, it's a motivation to say, seller, I have a buyer who's gone through the qualifying process. We have a good indication as to what they can qualify for. Here's the certificate. Please let my buyer come through and look at your property.
Awesome. Brilliant. Cool. Well, Justin, thanks very much. Appreciate that. If somebody wanted to get in touch with Uber, just jump onto the Uber website, or can they contact somebody directly?
Yes, they can contact myself. I'll leave it on the message as well.
Awesome. There we go. Brilliant. Awesome. Well, thanks for your time today. I appreciate it. And speak to you soon. Thanks. Cheers.
Thank you. Cheers.
Bye. Great. Perfect. Hopefully that gives you guys an idea of the finance that you can look at and opportunities that are there for you to get into a space that you can get into space and start financing a deal for yourself and look at financing either your first home purchase or moving on from there, your second property, third property, or growing your portfolio. Just remembering that the structured finance is slightly different. Again, something you speak to Uber about, but you need to be completely transparent with the guys at Uber so that they understand your position and can work with you to try and help you expand on your portfolio. So I'm going to just also just remind you guys that, sorry. Okay, so Uber have got this pre-qualify all the buyers prior to viewings. So again, you just use that Uber bond indicator that we put up the link on, and you can get pre-qualified before you start going and looking at properties. It really puts you in a much stronger position from a negotiation point of view, that a seller knows that you're really pre-qualified for the finance, and therefore the offer that you're making is more certain than others. Okay, so that was the traditional finance, and now I want to sort of get into the space of talking about sort of creatively financing property. Just want to answer Ludzi's question quickly here, which is, with the easing of the COVID restrictions, is property registration open? So I just saw a notification literally a couple of minutes ago that as of today, all the deeds offices are open. I saw a notice yesterday saying the Cape Town deeds office will be open tomorrow, but I assume that by the notification going out saying all deeds offices are open today, that they're all now open and all the transactions will be processed. Just be aware there is going to be a delay. There is quite a large backlog that they need to work through, and then they'll get there. So it will take a bit longer to transfer properties than it has in previously, but yeah, so that process is happening. So property registrations are open at the moment. Okay, cool. So let's talk about creatively financing property, and this is really where it could get quite confusing, but you need to really be creative and start thinking out the box. Buying property is like buying anything. If you can create a deal around something, create a structure, and you understand the opportunities that are created, and the fact that the offer to purchase agreement is literally an agreement that is really malleable. You can really do anything with it, as long as the terms and conditions in that do a few things, meet the criteria of an offer to purchase in terms of the Alienation of Land Act, in that you identify the property, you identify the buyer and seller, you identify the finance or how the money is going to be paid, and that the property is being sold and transferred. Outside of that, you can put a lot of other things into an offer to purchase to make sure that the deal works for you. Obviously there's tax considerations and timing and transfer duty that you need to be considerate of, particularly the fact if you put a delayed deal in place where the bank, the SARS will look at a delayed deal as a deemed purchase, and you might have to pay the transfer duty within 6 months of that agreement, never mind the transfer of the property. It's a few little nuances that you have to be aware of, but that's something you deal with with your conveyancer, and a very good conveyancer will be able to give you some really good advice on how to use the OTP, the offer to purchase, the contract, to create a nice deal for yourself, how you might delay that purchase in conjunction with the seller to maybe make it work for both of you. But I just want to talk about a couple of opportunities here, and how do you get finance for a property? Well, first and foremost, one of the easiest ways to do that is just form a partnership with somebody. If you have 500,000 Rand available and somebody else has 500,000 Rand available, you form a partnership to then go and buy a million Rand property if you're not financing. If you only have 100,000 Rand and you need 200,000 Rand, you find another person and you create a partnership. So that's the first step, is just finding a partner. I do want to be a word of caution is make sure you pick your partners carefully, and make sure also that the strategy you're going into, you realize if you're going to a long-term property strategy, you're going to buy property and hold it for 20 years potentially, that you're going to be in a marriage with this person for 20 years. And oddly, a business partnership, particularly where there's an asset like a property underlying that partnership, is much more difficult to get out of than even your own marriage. Divorce is much easier than getting out of a bad property partnership. So just be aware of that. When you get into a partnership, my advice is get into the short-term deals, a capital flip, short-term development, those sorts of things where there's a partner involved, and make sure that you're not sitting in a long-term space where your goals, your strategies, your visions might change over time because of circumstances. We dealt with that last week. Your circumstances might change, and therefore your strategies change, and you move apart from each other as partners. So you really want to get into a partnership for those medium to short-term deals versus the long-term buy and hold strategy. Joint venture is the next one, and a joint venture is where you maybe have no capital, but you've identified a deal and you've got time, and somebody else has capital, or you've got capital but somebody else has got time and skill set and expertise. So joint venture differs from a partnership, where partnership is you're putting the same into the hat and you're then doing a deal. With a joint venture, you bring in different things to the party. You could potentially also bring cash and skill set, and they bring some cash and some skill set, and it varies from there. So partnership and joint venture are two ways to get into space. Partnership is generally done in your personal name, and I'll show you after these slides why that's not the greatest idea. Joint venture is generally done in a structured way, using a company, dividing shareholding and profit share through a joint venture. Family investments, and this is traditionally called the bank of mom and dad for those starting out. And the bank of mom and dad are the ones who will lend you the deposit or stand surety for your deal, or lend you all the money for the property purchase in its entirety, including your transfer duties and transfer fees. So family investment is another opportunity for you to obtain finance from somebody else to get into a space where you buy a property. An angel investor is just, if you guys watch Dragon's Den or Shark Tank, those guys are to a degree angel investors, and that's a very similar thing. You might have a strategy or an idea or brilliant plan around property or development, and you go out and you go and find somebody who's got cash, who's interested in investing, and you'll make a pitch to them, you put a pitch deck together, you send it off to them, and you will then have a conversation around how they will invest the lump sums of money for you then to do this deal and then share in the profits in some way or form. That sharing of profit isn't always 50-50. It could be a 20-80 split, depending exactly how much resources come to the party from the angel investor, how much you're putting in, how much time and expertise. Remembering in all these three things, partnership, joint venture, angel investment, you really want to be aware of two things. Is you don't always split profit only according to how much money you put in and how much skill you put in, for example, or if you bring the deal to the table, but also how much time you're going to have to put in. And you need to put value on your time. Often people, when they're looking at property, only value the ROI, the return on investment, the return on my money in. Now, if I'm putting no money in, but I'm spending the next 365 days, 8 hours a day on that site, but I'm only getting 10% profit share, you know, it's not going to necessarily make sense for me. So you value not only the return on your money invested, but also value the return on your time invested. How much time have you had to spend on that site, on that deal? Structured finance, and Justin touched briefly on it, but structured finance is also one of the opportunities. And generally speaking, when you look at structured finance, you move away from the traditional retail banks, and you're moving more into the RMB, the Investex of the world, even F&B private banking. They get into the structured finance. What they do is they look at a portfolio overall, and they'll take your 5 properties and value that, and they'll give you a lending facility against the entire equity of that entire portfolio. So for example, if you've got 5 properties with no bond on it at R1 million each, they will look at it and say, okay, well, you've got 5 million rand with an asset here, that's asset-backed finance, it's secured against it. So they'll say, okay, we'll ring fence those 5 properties and we'll give you a 4 million rand, we'll give you an 80% loan to value of it, and they give you a 4 million rand facility, which is available for you to tap into. And it becomes much easier at that level. You can work with speed, you don't have to go through an application process. They do have a valuation process when you buy property, but you don't have to go through the rigorous or the reapplication every time you buy a property. You literally just tap into, it's almost like an overdraft with a valuation. So they value the property you're looking to buy, and then they put it into that facility. So much more structured. Again, that's based on relationship. That's not something you can just go and apply for at the bank. That's going to be building relationship with the credit committee and the structured financing guys. Interestingly, within the banks, it sits in between the commercial environment, where you've got the commercial lenders and the commercial division, and the residential division, the sort of more retail banking, the residential. The structured financing guys sit smack bang in the middle. They almost overlap each other. No one really takes much responsibility there. And they almost work together to then come up with a structure specifically defined for you. That's relationship building. That takes years of relationship building with a single bank, and proving you have the skill set, knowledge, information, expertise to be able to build that portfolio and look after that structured finance. Consortium, and consortium is one that is really easy to get into, and it takes a bit of planning, but it's a really good way to get into property with a bunch of friends or your family, where you, for example, over a period of time, and very similar to a stokvel to a degree, where you put 1,000 rand each into a bank account every month for 5 years, and that's 12,000 rand. If there's 10 of you, it's 120,000 rand a year, and 120,000 rand a year times 5 is 600,000 rand. 600,000 rand plus interest gives you 650,000. And at the end of 5 years, you're going to buy a property. You take the net income, you put it into the bank account, plus the 1,000 rand you put each. And at the end of 5 years, then you have 750,000. You buy a second property, third property, fourth property, and go that route. It's a really good way to get into property. It's a really good way to invest and get into property for much lower price point. Again, the problem with consortiums is, again, people's opinions, strategies, visions, goals move away from each other. So you need to have very clear entry points going in, very clear exit points going out. And I mean, I would put, for all of these things, very good contracts in place to make sure that the relationship is very clearly defined. A lot of you would be these days getting married and looking at putting antenuptials in place, and we put antenuptial agreements in place for our marriages, yet we get into business partnership and we never have a signed piece of paper. And it's really illogical. There's way more risk, or should be way more risk, in a business relationship that there is in marriage, although who knows these days. But yeah, so it's important that you do have the paperwork in place. And again, I referred to last week saying there's a difference between your attorney and your conveyancing attorney. Your attorney takes care of this stuff, the structuring, the deal, the entry, the exit, disagreements, mediation, arbitration, all that sort of thing. And then your conveyancing attorney just takes care of the transfer of the property. Access bond. So if you do have an access bond and you might have some money in your access bond, you can tap into that money, pull it out at the pre-existing rate and go and buy another property. And as long as that property is generating more income than the cost of that access bond, you're the net cash flow positive. You can pay off that bond and sit with money free again. So using your access bond or your access facility is a way to then again finance a property that you might want to buy, your next property, for example. And then one of my favorites is an installment sale agreement. And really the way to describe an installment sale agreement is the best way, is the way most people buy cars these days. You put down a deposit on a car, you pay it off over 5 years, and you may or may not have a balloon payment at the end of that period. And it's clearly defined in the Alienation of Land Act, Section 20, and I think Section 4 describes exactly how that installment sale agreement needs to work, what needs to be included, when the transfer duty needs to be paid within 6 months of that agreement. And it protects, and it's a brilliant piece of legislation for property buyers because it protects both buyers and sellers extremely well. It's a very good mechanism to buy property, and something definitely worth looking at. You can't buy all property like this. There needs to be specific situations, and the situation really relies on the seller not requiring all the money right now. So potentially looking at investors who've got themselves into trouble, who need to get out of it because they can't afford the cash flow on their property, the cash outflow. So you can maybe pick up a couple of investment units where they only need the capital later on. So it is a really useful tool, installment sale agreement. Again, there are specific attorneys that really deal with it well. I know 3 or 4 that are very, very good at the installment sale agreement space. So if you are interested in installment sale agreements specifically and getting into that space, then it's definitely, get hold of someone in your team, and I can put you onto the right attorneys that can give you the right advice around installment sale agreements. And then we look at something which is common, which is rent to buy. Now, rent to buy is an interesting one, and often it's a combination of an installment sale agreement, which I've just referred to. So it's a lease with an installment sale agreement in it, or a lease with a delayed OTP, a delayed offer to purchase, where you buying it subject to certain conditions at a later stage. Or it's a rent to buy, so you rent the property with the option to buy the property at some point in the future, and there's an option agreement. And an option agreement gives you the right to buy property at a future date at a certain price, but not the obligation. So if you know trading and shares, it's put and calls, put contracts and call contracts is the same type of idea, where you look at the property right now, you say, okay, it's worth R1 million right now. I would like to buy it from you. I want the option to buy it for you at 1.1 million rand in 2 years' time. You pay a deposit on that, an option premium, and you'll then sit and rent that property for 2 years. And at the end of 2 years, you will then look at the property value, and if it's worth 1.4 million, you have the right, but not the obligation, to buy it at 1.1 million in the future. But you also, if that property is only worth R1 million in 2 years' time, you then have that decision to make. Do you want to buy or not buy that property? What's the benefits to the seller? Well, the seller gets that option premium up front now, also gets a tenant that is staying in the property for that period of time that they know is going to pay because they've got the option to buy it later on. And also you are more likely to take care of that property much more. The maintenance will be lower because, again, you intend buying that property. That's your intention. So rent to buy is a nice, really interesting structure for both sellers and buyers. It's probably not as strong as installment sale agreement in terms of the type of agreements. Contractually, installment sale agreements super strong, really easy to defend in court if there's any issues, whereas a rent to buy option, you need to litigate that and fight that. So, but a really good space. And the last one I've got here, which is rent to rent, which is a way to get into property without actually buying property and make money out of property without actually owning it, is a rent to rent strategy. And that is renting a property on a lease, a long-term lease, for example, where you would rent the property at 10,000 Rand. And then, for example, you might rent out individual bedrooms to students because of the student area at 4,000 Rand a bedroom. If you've got 4 bedrooms, that's 16,000 Rand income, and you're netting 6,000 Rand on rental, and 6,000 Rand will then have to be used to pay some costs. So you'll sit with a profit line. That's a really good way to get into property if you, for example, don't have a great credit record at the moment, or you maybe don't have the income showing at the moment that you need to. or you, for whatever issue, are encumbered to get onto the property ladder, rent to rent is a really good strategy for you again to, and that can be applied in any scenario. I'm going to give an example of rent to rent quickly, just to sort of help it materialize your minds. Is that often builders, when they're building at your property, they're building a wall, or they're digging a pool, or they're doing any work at your property, will often not own a compactor, a ground compactor, for example. You know, they're not expensive pieces of equipment. They don't use them that often enough to justify their investment. So what they'll do, they'll go to a local hire shop and go rent that compactor for 1,000 Rand for 3 days, and come arrive at you and compact all the ground and everything else, which is great. And they hand you an invoice for 1,500 Rand. You know, remembering you've already paid the labor as well. So you're just paying 1,500 Rand for the rental of that equipment. They've charged you 1,500 Rand. They then take the equipment back to the rent hire company, and they pay the 1,000 Rand, and they've made a 500 Rand profit. You're doing exactly the same thing in a rent-to-rent strategy. It's a really good and easy way to get into property without having to get bonds and invest in finance. The last thing on rent-to-rent is that it's scalable, massively scalable, and is not limited in terms of how much you can build, because, you know, lending, the problem with not problem, but one of the issues with it around getting finance and debt is that you're always going to be limited to how much debt you can have at any one time, depending on your affordability, your credit rating, everything else. Whereas rent-to-rent doesn't rely on that. It relies on the fact that the deal can be made with the owner. The owner retains the property and the ownership of the property. You're just leveraging the lease agreement portion to make a profit. One negative around rent-to-rent is that you don't benefit from capital appreciation. However, at least for the foreseeable future, yeah, I'm talking 2 to 5 years, that's not going to be of major concern. You know, capital appreciation against property in this country is going to be stagnant for at least the medium term. So I don't think it's a huge issue that you give out capital appreciation for the right to, or the ability to make some money on property and in property. And the last one I put here is start a business. And I put that there because it's actually why I got into it. So we started investing in property, and then also hit this ceiling that we couldn't get any more finance. And we had all the rental income, and it's all we were doing. We were investing in property, and all we had was our rental income. And the banks did exactly the same thing they do here. Is they then limited us, saying, well, we can't lend you anymore because you've hit your ceiling. So what we did is we started a business to start generating extra income to pass our salary, to then enable us to buy more property and carry on going. So starting a business is one of those ways that you can boost your income. And I'm not saying start a business in terms of full-time business. You know, you just need to supplement your income. The bank might just only require 2,000, 3,000, 4,000 Rand extra income a month. If you can create a business that generates that for you, and you can show that it's income, you have therefore the potential to earn more money. Keeping in mind that you where I'm speaking about that side hustle is supplementary income and not your main income, because once you start making it your main income, you become self-employed, which then just opens a whole new kettle of fish for you. So you start a sideline business, start a side hustle, and that's potentially going to help you get more financing. If you are interested in that, and sort of there's a little quick sell here, tomorrow morning I've got an epic conversation with Nick Haralambis from Nick Harry Socks. If you guys know Nick Harry Socks, they're really cool socks, bamboo socks that are being sold. But Nick is a author of Do Fail Learn, and also a book called How to Start a Side Hustle. He's a global speaker on entrepreneurship, and I'm having an epic conversation with him tomorrow morning. So if you are interested in that, I'll try and put the link up before the end of this, where you can have a listen to Nick's story and his advice around starting Nick Harry Socks for 5,000 Rand and now a multi-million Rand business. So really, really interesting. Cool. So starting business, again, another way to finance property. So now we're getting into the meaty stuff, and I'm going to not rush through it, but I am conscious of time. But we've spoken about finance now and opportunities, 11 creative ways outside of the vanilla finance to get into property. But now let's talk about asset protection structures. And really it's about you protecting yourself and protecting your assets in the upside. I've got a little video insert here for you quickly. Firstly, you've got to have your trust structure in place. You're going to have a trust. So what I'm going to talk about here is different structures used, and I'm going to show you the generic structure that investors can use to invest in property. So first is a trust. So trust is a separate legal persona to yourself, and can have ownership of shares and own assets, and it sits separate from you. It would have trustees on the one side, which are responsible for taking care of the trust and making decisions within the trust that are to the benefit of the beneficiaries of the trust. So trustees on one side and beneficiaries on the other side. You would need to generally have 3 trustees. You'd have yourself, your partner, and an independent trustee. The courts require independent trustee these days because they've seen so many court cases where there was 2 trustees, 50-50, and there was just at loggerheads. So so you need to have a 3rd trustee in place that can break any disagreements. The trust is there to protect your assets, to ring-fence risk, and minimize estate duty. Remembering that if you are a trustee and a beneficiary of a trust, and when you pass away, the trust remains intact, and all happens, you drop off as a trustee, you drop off as a beneficiary, and it continues. So it continues beyond your passing. And the important part there is all the assets that are within the trust aren't affected by your estate duty. So there won't be any estate duty applied to those assets. You also ring fence your assets. You ring fence your personal assets, your personal sureties and everything, and liabilities and the issues away from the assets sitting in the trust. So they are, again, separate legal persona. So if you own a house in your name and you do something wrong and you are sued and you have to pay 10 million rand, they take your million rand house, but they can't go after the assets of the trust. The important thing, however, is that you manage a trust properly and effectively, and you don't, as a trustee, control it as if it's your own bank account. So it's important that you have all the paperwork in place, that you do the annual meetings, that you do all the procedures and administration rights around it. Because if you don't and you operate as if it's your own personal bank account, you're going to have an issue in that the courts will look at it and say, hold on, although there's a trust in place, you were acting as if this trust didn't exist. You're accessing as your personal bank account and to your directly own benefit, and therefore we take away the existence of the trust and we see you as an individual, and therefore you're going to be taxed as an individual. So that is an issue. The question here, quickly from Ipling, is you can be both a trustee and a beneficiary of the same trust. Correct, you can. You can be a trustee and a beneficiary of the same trust, remembering that the decisions you make as trustee must benefit the beneficiaries of the trust and not you directly. So keep in mind that if you've got 4 or 5 beneficiaries, although you're one of those beneficiaries, the decisions you make as a trustee need to benefit all 5 in accordance with the trust documents and can't just benefit you directly as one. Okay. Then you've got the individual. So you've got yourself, you've got the trust, and then you've got yourself as an individual, another structure. Now, the important part here is that you need to minimize your personal assets as much as possible. Again, from an estate duty point of view, you don't want to have too many assets in your name. You want to minimize your personal liabilities and also the effect of any personal liabilities on any of your investment assets that sit away from you. You want to be able to maximize finance. And remember, us as individuals and as consumers are regulated by the National Credit Act. The National Credit Act is very clear in terms of responsible lending, and the banks are very particular about responsible lending. They want to make sure that they don't get in a position that they've lent to you irresponsibly and can be fined, because the fines are huge and the implications for them are quite big. So they are very, very strict around that space. So if you want to maximize finance, you actually have to move your investment structures away from you as a person into a space where you can build a business, and we'll get to that now. And part 3 here, you want to minimize tax as much as possible in your individual name. And the 3rd structure we're going to talk about quickly is a company, and that's a Pty Limited, registered at SIPC, CRPC. If you have a CC, I'd recommend you convert it into a Pty Limited. There's absolutely no value in a CC these days. Keep in mind that a CC, you are a member, and as that member, you take personal liability for that, but you also own the company. So they're combining the ownership and the operation and operational responsibility into one person as the member. Whereas with a company, you can be a shareholder and you can separate ownership and operations, being a shareholder, and then on the other side, a director. So it's important that you have a Pty Limited in place. It's much more sophisticated and a much better structure to have. So, and this is where you're going to create your wealth. You're going to separate your strategy, so you can open individual companies. It costs you 175 Rand at SIPC to open a company. So you can just open companies, as many as you want, and let them sit there. And then you ring fence each strategy or each deal or each joint venture into separate companies so that you ring fence them away from each other. You don't want to put everything into one company because you risk all your assets. So if one deal goes bad, it could affect all the good deals, but also you want to separate your joint ventures from other special purpose projects or anything else, as well as separating, for example, your long-term strategy from your short-term development strategy. For two reasons: they're both risky, but they also have different tax implications. You don't want to muddy the waters for SARS, so you want to separate them as much as possible. And last one, you want to be able to maximize finance. If you have a company and over a period of time you're running that company and you're doing very well and it starts generating income, in 3 to 5 years, that company sits with its own credit profile with your bank, and you can then start getting lending against the company and not in your personal name as a director and getting surety. So it's a way for the medium term to build the ability to maximize finance over a period of time. So I want to look at it. So you've got these three structures, but then, one of the considerations here is what are the tax implications? You've got to just think about tax related to each of these structures. And there's two types of tax that are important to consider here. There's obviously more with a company. There's dividends withholding tax or secondary tax. So there are a few things to consider when you're looking at taxes. But for our purposes, is really two you want to look at is income tax and tax on capital gain. Now, remembering income tax on the income tax line in a trust, in the individual and the company, the taxes differ slightly. And in a trust, the tax rate is 45% on your net income. In individual, the highest tax bracket is at 45%. So if you're earning, I think it's 1.2 million or 1.5, I think it's 1.59 million or something. Above that, it gets into the 45% tax bracket. And then a company is 28% tax across the board, unless you're taking advantage of small business tax. But let's just say it's 28% on your profit. Capital gains tax, however, on a trust is 45% of 80% of the capital gain. So if you generate R1 million worth of capital gain on a property, they will tax you 45% of 800,000. In your individual name, it's 45% of 40%. So sorry, in a trust, the effective tax rate is 36% capital gain. In the individual name, it's 45% of 40%, which is effectively 18% against capital gains. So again, if you generate R1 million of capital gains tax on a property, now this investment property, not your primary residence, but on investment property, R1 million, you will then get taxed 18% of that R1 million as a capital gain. And then 28% of 80%. So again, 80% of the gain, million, you get taxed 28% of 800,000 if you hold that property in the company. Now, there is a difference between individual and company. Again, it relies on your strategy, but the important part is also to look at that income portion. So the top portion here. So keep in mind that the 28% versus the highest strategy of 45%, assuming you do very well on an ongoing basis, will offset the effect of this higher tax rate here. 28% of 80% is 22.4%. So it differs by 4%, but you can see here, this differs by almost, 18% difference here. Is that right? 17% difference here. So no, 18%. So yeah, so it's important that you do consider the structures you're going to use to buy these properties and do it right up front. If you have already bought in your personal name, it's not the end of the world. It's a decision you've made, but it's important that you can sit down with an attorney who understands structuring, your accountant, to really put the right structures in place for the future. Now, if you're thinking maybe I should move properties from my individual name into a structure, again, sit down and look at the costs. It is quite expensive to move properties from one point to another. So it is quite important to understand that you need to really sit down with your accountant and understand the implications of moving that property across. If I could just ask you guys, I see a couple of questions here in the chat box. You don't mind putting into the Q&A, it just helps me follow it. But this here, aren't trusts more expensive with regards to tax? Absolutely, it's 45% Buerta. So what I'm advising from a structure point of view is this, and let me show you here. So you're going to have the this is again generic. This doesn't apply to everybody. And please go sit down with your tax advisor and your accountant and your attorney and figure out what's the most effective structure for you for what you have at the moment. But this is a generic structure you should have. So you're going to have a trust in place, and the trust is going to own the shares in your property company. And so the ownership of that company will sit within the trust. That trust can also own your mask business and your drone business as well, or any other business you have. But what you do is you ring fence all those things. You have your real estate companies and your various strategies, as well as your trading companies sitting outside. So you don't need more than one trust. You just have multiple companies ring fencing the individual risks away from each other. You as the individual will then sit as the trustee of the trust, along with 2 other people, as well as the director of those companies, either the sole director or one of several directors of the company. So you'll have operational control of those companies from a director point of view, but you won't have ownership, because the ownership is vested in the trust. Now, you might have within the trust only a 50% ownership here, because the other 50% is sitting in somebody else's structure. So that's whether you're having joint ventures in place, for example. Okay. And then you've got your beneficiaries, which is your friends, your family, whoever you choose to be beneficiaries of that trust. So that's also important to remember. So it could be you, your family in general, and that's who it would be. And those people, and it's important within your trust deed to ensure that you don't only define who the beneficiaries are, but you enable yourself through the trust deed to add beneficiaries without having to get a trustee resolution, that you can just contractually add those people or define who those people might be in the future. For example, in my trust deed, it says that myself, my wife, my kids are beneficiaries, as well as any future descendants of me can be added to the trust without any issues. So it's important that you do keep that in mind from a trustee point of view. Again, it's important to go to somebody who understands trusts and does structuring versus just any attorney. So again, the divorce attorney versus the structuring attorney. So quick one here from Buerta. Regarding trust as an independent trustee, what arm's length should they be? Can be a parent, must be unrelated. So in general, it should be unrelated. You don't want it to be, the first thing is from a conflict point of view, you don't want it to be biased towards one or the other. So you would try and have it unrelated as much as possible. It's very difficult to have that unbiased opinion, but I think somebody that you really trust is vitally important. So it's important to have that independent trustee. You can appoint an independent trustee who could be an accountant or a lawyer, which is completely arm's length and professional relationship. I'm not as keen on that as I am on maybe somebody that you know well, who knows the family well, who can make decisions in terms of your family versus an academic opinion. And what's the benefit of a company versus a trust? It's state duty only. So again, so it's a state duty. It's a company, much lower income tax rate, much easier to get finance against being a company than in a trust, and then ring fencing your risk away from each other. So so I mean, there's a lot of administration that needs to be happen through a trust. Trustees need to have meetings, need to document everything, need to record everything. Whereas as a director, you have the ability to run a company much easier. So I think there's multiple uses of a company over a trust, but the trust is really the ownership structure versus the trading structure. It's really important that you don't trade through a trust. The taxes are much higher and much more difficult to transact through that. So I mean, like I said, this is the generic structure that is recommended for investors to get into and make use of. So it's a trust with your companies, beneficiaries on one side, and you as the trustee and potentially beneficiary on the other side. So that's just again a quick overview of the structures and again, opportunities to finance from a vanilla point of view. Traditional mortgage, go to somebody like Uber, let them apply to the bank for you for finance. Then you can look at the 11 ways I've given to additionally finance property in terms of creative finance, creative structuring, and hopefully Cara next week will be able to give a couple of other ideas of suspensive conditions we can use to buy property that could be a little bit more creative. And ultimately what you want to do is you want to protect yourself from a few things. And as an investor, you're trying to do a few things. You're trying to de-risk yourself. You're trying to maximize your income. You're trying to maximize your financeability as well. So you want to maximize finance, minimize risk, and minimize your taxes as much as possible, and really ultimately create that legacy. So retain that value within the structure you create for some sort of future opportunity. If Blaine's asking if crowdfunding is the same as consortium, I'd say no, and I say no because crowdfunding seems to be a very unstructured way to invest money into something, so crowdfunding. you know, it's unregulated, it's uncontrolled, and you know, it's a good idea for some people. You put $100 in, and a whole lot put $100 in, and then they go from there. Where the consortium is a structured and contractually created process, where there's a bank account, there's decision making, there's meetings, there's a whole lot of stuff that happens around a consortium that I don't necessarily think happens in crowdfunding. I think crowdfunding has just been used, and I mean, this other one is blockchain and cryptocurrency. So investing property through crypto, it's all really silly, you know, until it's really formalized and properly done. You know, we all just risk our money in these fads and these schemes. You know, if you want to get into investing in property, you really need to just go down the traditional route of proper contracts in place, proper transfers, proper deals, and let the guys come from a space of really creating proper structures in place. And then, so when crowdfunding is properly regulated, then maybe take a look at that. Stockfiles is one of those opportunities for you to look at. But again, you know, stockfiles is also the regulations around stockfiles are very, very light at the moment. And I suspect that it could be misused and mismanaged to get into that space. So just be quite careful on how you get into that space. I would rather you build good relations with people and you invest with good people than get into space where you're just desperate to get into property and you get into structures that seem amazing, but just, you know, could end up you losing your money. So Epling, hopefully that answers your question. Awesome. So, I mean, just in terms of questions, I mean, you know, here is an opportunity just for anyone to ask questions that you might have. You know, let's just bridge the gap of understanding. If you do have an issue around understanding, you know, ask me any questions you might have, and then we can finish up for the day. So, pleasure, Epling. Thanks for all the questions. Awesome. Does anybody have any other questions, or sort of we're done for today? Just see if we've got anything. It helps you guys ask some questions during the session, so we come to this point. Cool. So again, thanks for joining today. Hopefully that sort of gave you a nice overview of property investing and the finance side of things and structures. Again, if you do need to get hold of me, you can get hold of me via the offices that you guys have gone there. I don't, Megan, if you are listening, do you mind posting the Zoom registration link for the chat with Nick tomorrow, please? That'd be awesome. So quick one, we did strategy goals and expert team last week. Today we did asset protection, structure and financing. Next week we're talking about the after purchase. So listen, let's get into the nuts and bolts of buying a property and what should we be conscious of in the after purchase. I mean, I know we're an estate agency, but you really need to be conscious of these estate agencies put very standard terms and conditions in place. There's two reasons for that. They know their contracts very well. They get all their agents get taught to understand their contracts, understand their space. But part two to that is that they really are ultimately also trying to protect their commission. There should be nothing wrong with you using your own after purchase, as long as that after purchase is drafted properly to protect you, both the buyer and the seller. So it's important to understand how an after purchase works. What are the suspensive conditions you can put in there to protect you from an investment point of view? And then let's look at the conveyancing process, understand how long that takes and how we can use it to our advantage from an investment point of view. We'll then go into tools and research the week after. We're looking at Lightstone and TPN, running the numbers, return on investment. I can't wait for that one. I think it's really cool. And I'm just going to go through a basic running the numbers on the deal. I'll also provide you with a spreadsheet you can use to run the numbers on your deal. But the important thing is you understand how to use a spreadsheet so that you get the right answers. And then again, property management, asset management, the Rental Housing Act and evictions. You now got this property. What do you do and how do you take care of it? And understand, to be fair, what we do and what we work on and how we try and make sure that your investment is looked after while it's in our hands and in our care. Megan's posted in the chat link the registration for tomorrow's chat with Nick Haralambis from Nick Harry Socks and Nick Harry Fashion, to be fair. I'm really looking forward to that. And if you guys also, I'll be posting a link during that chat tomorrow. If be able to buy his book at a 20% discount as well. It's at 10:30 tomorrow morning. So 10:30 tomorrow morning. You guys are all welcome to join that chat. It's the epic conversation tomorrow morning at 10:30. So guys, thanks very much for joining today. Again, these sessions are free. And really the reason that we've been doing these are to just sort of add value to everybody, to try and encourage people to look at the positive, look beyond lockdown, know that there is going to be a post-lockdown period, and we need to start looking at the opportunities that have been created for ourselves, and enable ourselves to build, because ultimately this country needs entrepreneurs going forward. It needs people that are going to invest in the country and invest in growing the business, growing the country as much as possible. So, you know, please ask everyone to join, and anybody and everybody. You don't have to be an only Realty client. You can be anybody and everybody, friends, family, guests, anybody you work with is welcome to join these. They're welcome to go and watch today's and the previous session as well as join us on future sessions, ask questions and get involved. So yeah, these are open to anybody and everybody. So again, thanks for joining, and we'll see you all next week. Just last one, next week will be at 1 o'clock versus 10 o'clock in the morning. So next week and the weeks after will be at 1 o'clock in the afternoon versus 10 o'clock in the morning, just for that note. So we'll be changing the links that you might have used for the next 4 weeks. So perfect. Thanks very much for joining today, and see you all next week. Thanks very much.